Peace. Once again, coming at you guys with another video. This time, this video is what makes up a credit score. Now, your credit score is composed of 5 different components. Your payment history, which is composed of 35%, credit utilization, which is 30%, credit history, which is 15%, new credit 10%, and used credit is also 10%. So this alone will show you when you miss a payment or you're late on a payment, how greatly impacted your score is. In fact, a late payment stays on your credit report for 2 years. Now, which will tell you how much it impacts you. However, a good payment history and a low utilization greatly influences your credit score. It helps it a lot, significantly. Now, credit utilization in the credit world, your what's considered maxed out in the credit world is 30%. It's anything over 30%. So let's say you have a Visa card, right? And your Visa card has a $300 limit, right? Now, you should set a new limit for yourself in your mind. Take a third of the limit that they actually give you and make that your new limit. So now your new limit would be $100, right? Your new limit would be $100. So this would be your safe zone. You stay in this particular safe zone, you keep your utilization low, make your payments on time. Now, your credit history. Credit card companies look at credit history in 24-month intervals. So your credit score also, as I stated in a previous video I did, what is a credit score? The credit score is based on an algorithm, is made from an algorithm that's based on risk analysis. So obviously 350 being the lowest and 850 being the highest in scores, that's the particular range that they're gauging from. So what that is for is in order to measure the likelihood of you going 90 days late in 24-month on a 24-month basis. So in every 24 months, they want to see how likely are you going to be 90 days late. All right. So now, with the credit utilization, now the 24-month period deals with the credit history. So if you have a card let's say you have a card and you might have a 2-year or 5-year, whatever, 2 or 5, something like 2, 3, with a couple of years history on it, and you up and get 5 new cards in the same year, it's not going to influence your score. Will go up slightly, but it won't go up as long as your utilization is low, your payment history and everything's all right. It won't go up significantly because those are all new accounts. So there's no history tied to those new accounts. So at least significant 24-month history, which what they check. Also, used credit is how often you're using the credit. Now, if you don't sit here and apply for new credit cards, or your credit utilization, like these two, if you don't have all 5 of the components, it won't necessarily impact your score in a negative way, as long as these 2 main components are kept good. You're good in your payment, your utilization is low. In time, your credit history, you utilizing credit, you'll get that 24-month history. So you can still, maneuver. However, once you understand how to use these 5 components, it'll make it a whole lot easier for you to deal with credit. You'll have a leg up on those who are trying to figure out how to go about it. So now, when you're looking for lenders, one of the things the lenders look at is your credit profile. So your profile, basically, as I stated in a previous video, is basically the report card in the credit world. right? So if you're looking to go for something like a FHA loan, first time home buyers loan, they require a 680 credit score, right? So you having the understanding of how these 5 components work, it puts you in position for you to be able to build your credit up or repair your credit if need be, because you know exactly what to do to move the scores up. Now, also, besides the score, you need a good profile, a strong profile. So if you may have a 750 credit score, but you have one credit card, and you can still get denied for loans. The reason is not because you have bad credit, because your profile is what they call thin. So what lenders like to see is a good mix. They want at least 3 lines of credit revolving on your credit profile. But they would like a good mix of, revolving credit, installment accounts, and open accounts on your credit report. But you need at least, even if it's one a piece, but you need at least 3 different credit accounts, whether it be revolving, installment, and open, or reporting on your account and be in good standing. All right? So these are the 5 components, as we said, that make up your credit score. It's based on risk analysis, and that's pretty much it when it comes to what makes up the credit score. Now, you can sit here and it would be ideal to look at these things. Stuff like this is you should be able to teach your kids. Because once you get this, you can teach your children this, and you can actually add, once you understand how the components work and you utilize them, you can add your children on. From, let's say, your children are at 13 years old, you can add them onto your accounts as authorized users. So when your child turns 18, they already have 5 years of good credit history that they're starting off with. All right, that's just a little tip, so we can advance and move smarter. Now, that's it for right now. We'll come back at you guys with another video. You can follow us on Instagram at Mr. Flip These Bricks, or YouTube at Mr. Flip These Bricks. All right, and remember, work smarter so you don't gotta work harder. All right.